So the first one I'll show you, this is for a strategy for explosive price spikes. So this is the Iron Condor debit spread. All right, so here's an example on one on CRM, so Salesforce. And Salesforce historically, looking at its post-earnings or pre-earnings, its history tends to have some pretty big price movements after its earnings release. So here's one that was just set up in November. So here, just kind of walking you through it. So this was on the 29th, and this was on a Wednesday, and so it was trading. This Salesforce was going to have the earnings release after the close. So with these trades, you put the trade on before the close. Okay, so typically the last hour is typically when I'll look to enter the trade. So here it was trading at going into the close, it traded 230.35. And then the option expiration was 2 days later on Friday on 12/1. So here's what happened on the first. You can see it's had a huge price spike. It was now at 260. So this went from, you can see the chart here, the implied volatility had been creeping up. It collapsed, but here's price spike. Look at that huge price spike. And then it closed the next day on Friday. So here was on Wednesday before the close. The next day it gaps up, and now on Friday it's trading right here at 260. So huge move. So this was set up for a big price spike movement. So the expected move was going in at 4.88%. That the market was looking for to a normalized move would be around 5% up or 5% down, and on this one it closed up 12.87%. So to take advantage of that, thinking, okay, well, we know historically CRM has potential for big moves up. How can we trade it? Here's one way you can do it. So this was doing the Iron Condor debit spread and just kind of walking through this trade. The expected move again was 4.88% up or down. So set the trade up. All it had to do was move and close 3% up at expiration or 4% down. So skewed it a little bit more to the downside, thinking, okay, there's a better probability for it to be on the upside. So we can do different skews to decrease the cost of the trade, but that's how it was set up on this one. So it had the big price spike. So here was the trade. So this was doing the Iron Condor debit spread, which kind of looks like this. So we're long a call debit spread and a put debit spread. So we don't really care which way it goes, up or down, but we want it to at least be closed either over 3% at expiration or below 4%. All right. So the combination of these two spreads together had a cost of $168. And then the difference, it was a $2.50 wide spread. So the potential profit was the difference of 82. So, the 82 on 168 risk, that's a 49% return. And that would be, over a 2-day period if you wait until Friday. So this was set up high probability trade based on what CRM had done in the past. All right, so then here's what it looks like, the structure. So here was the basically your call debit spread side. Here was your put debit spread side. So did not care what it did. All I wanted to do, make sure if it closed at 3% up,